America has become too expensive for ordinary people to survive.
And feeling like you were the only one. You were not the only one. Let me tell you this. I know we initially got this credit card because we thought we were going to be good and responsible, and we wanted to get the cash back, and we wanted to get the travel perks, and we told ourselves, like, I'm not going to overspend. I'm going to pay it off every single month. But then one month that didn't happen, and then one month turned to two, and one purchase led to another, and then things started to snowball, and now you are completely stressed. You feel like you are completely buried and you don't know what to do. And it's almost gotten to the point where you're like, what does it even matter at this point? I might as well just spend. I might as well just get what I want. I might as well just put another couple $100s on here because we're already so buried. What's the point?
Chances are you know a lot of people that are in severe credit card debt and you may not even be aware of it. I did find this article on Newsweek and I wanted to share it with you guys. It's about a young woman who is struggling with almost $30,000 in credit card debt. And she shares her story because she feels like no one is really talking about the fact of how many young people are in this much financial hardship.
And it's true. It's true. Because you know who are the least likely to watch these velocity banking videos? Young people. If you ever look at the analytics, and my analytics are going down because I haven't been posting, but you know what? Let's just see who the audience is. Ooh, 58% new viewers. That's interesting. Okay, let's see what the age demographic is, right? So we can figure out the age demographic somehow. So break down, let's do viewer age, right here. And then we see that the young people ain't here. Okay. We got some of the more experienced in age folks here, but not the young people. But what do you think? Do you think if young people watch this, this would change their lives, especially if they're maxed out on credit cards, right? I don't know if it will, but we'll just hope for the best and try to pay off our debt. And then as you can see right here, we're maxed out on credit cards, right? So we have 10 credit cards right here, 10 credit cards, and we only have a penny left over in checking and savings. And the way that I like to introduce debt payoff, aka velocity banking, is just ask people when they look at this, hey, if you're in a lot of debt and you have only one penny left over, do you need to make more money to get out of this hole? Right? And I pretty much guarantee you that the average person who's looking at this is thinking of bankruptcy if they're in this situation. Now, the fact that the income is more than the expenses is a really good thing, even by a penny, especially if you have all this debt, right? Because we have to understand that debt is optional. Um, Expenses that you always have to pay for are not, if that makes sense. But anyways, let's get to it. Velocity banking, what is it? It's a debt payoff strategy where you throw all of your money into debt using something called a line of credit. And so the first step to doing velocity banking is just simply creating a budget, income, expenses, and then expense breakdown. You list every single debt that you have, and we have lots of debt. And not only that, we have our expenses that we pay for, food, gas, insurance. So even if all of our debt were paid off, we'd still have to pay for these expenses, right? And so now here, what we're going to do is with our checking and savings, we're going to assume same income, same expenses, but we're going to treat our checking and savings a little bit differently than the average person slash bear. So the average person thinks it's a good thing to store money in the checking account, right? Whereas in velocity banking, we just essentially do our best, right, to not pay for things out of our checking account. We just don't do it, right? Or we don't pay. What we try to do, okay, is make sure that our checking account is essentially the middleman of our money. See, in average American banking, the checking account is the final destination of our money, whereas in velocity banking, it's the middleman, right? And then what we're going to do is try to move some debts, consolidate them into a line of credit, increase something called our cash flow, and then just go from there, right? And so we have this thing called the cash flow index. What is it? It's basically the debt amount divided by the payment, gives you an arbitrary number, and just kind of think of this as a ranking system, and the lower the number, the more bang you get for your buck. So here, you see this big number right here, 310. What does that mean? It means that if you pay this off, you don't really get that much bang for your buck for paying it off, right? So if I give someone 350,000, I literally have to give them 1,100. I only get $1,100 back in my cash flow. Whereas if I give someone 30 grand, I get about comparably the same amount. Okay. All right. So now this is what we're going to do. We're going to do this. So 5, 8, 15, 27, 30, 5, 8, 15, 27, 30. So how much credit card debt is that? We're going to take these low cash flow index numbers, right? So $170,000, and then we're going to move into something called a line of credit. So what is a line of credit? Basically, it's a financial tool where you could borrow money, pay back, and then use it over and over again. Now, if you ever take a look at the bank's website, you might see a button like this, transfer funds, right? So transfer funds. Now, here's the secret to getting lines of credit, which you might not have ever heard from other places, is that banks don't lend money to people who need it, because people who need money don't tend to pay you back, right? So you're a huge risk, and so that's part of and quote underwriting, right? If you need money, they don't pay you back. Okay, and so that's basically how that works, right? And then let me just go ahead and do this. And so now 5 years. So this is a loan calculator, but let's start off with this. So now that we moved the low cash flow index numbers into the line of credit, well, guess what happens here? Okay. See, maxed out credit cards are essentially no problem because now we turn this penny into $5,655 and a penny. Okay. See how easy that was? And then the final step is you put your entire paycheck into the line, take expenses out, and then rinse and repeat over and over again. And yeah, we just do this until it goes to basically zero, right? So we see that in 35 months, this gets paid off. So that was really simple. To the point where I'm bored, 35 months, and it's gonna be 170K. And then we just do that with all these other ones here. And then, okay, so we have an auto loan, student loan, and a mortgage. So I'm just go back right here. So this is gonna be 30 month, 35 month, 35, right? So we have a loan calculator right here. You type in the current month, they'll give you the current balance. We just use that cash flow index again, take the lowest number, bam, and then alakablam. So this is gonna be plus 9568.69. And then you see that gets paid off in 1 month, right? And so now this is zero, okay? And then our cash flow is over 6 grand. I'm gonna do this right here. So minus 6050.32. And then what we can do is just move the student loan here, although I wouldn't really necessarily do that. But I'll just tell you that with the mortgage, and this is a 50-year mortgage, you got to be a little bit careful just moving loans into lines of credit. But let's just move the student loan into line of credit plus 64597.37. And then what's our cash flow? Our cash flow is an extra $943. And so that's $7,000 of cash flow. And then I'm going to do this right here. And then that's going to be 6994. Yeah, 6994. And then see how fast it takes to pay it off. And then we see that it gets paid off in about 46 months, right? 46 months. Uh-oh, I didn't even calculate. Oh yeah, it's 30. Oh well, it doesn't matter. All right, so it's 170 plus 22 plus 85. So that's 277K in about 46 months. Yeah, 46 months, 277K, right? And then now we just do the 30-year mortgage. So I'm just going to go right here, type in 46, right? That's the current balance of the mortgage. And then with the mortgage, especially if you have a big interest rate difference, you don't want to move that loan into a line of credit, right? You have a big CFI, means that you don't really get that much bang for your buck. If you move it into a line of credit, you're going to end up paying a lot more than you have to, right? So what we're going to do is something called chunking, which is moving a piece of the loan into a line and then just repeatedly paying it off over and over again. So what does this 11 grand mean? Well, it kind of means this, right? So you just kind of move like 11 grand plus 11000 into a line. What am I doing? Yeah, so into a line, and you just see how it just gets repeatedly paid off, right? Yeah, I just okay. That's really what chunking is. And then you see that it gets paid off in 3.7 years, 20 grand of interest, 50-year mortgage, and then I think there's an alarm going off. Oh well. Anyway, so let me just kind of go here. So this is going to be 0, and then it's going to be 46 divided by 12 plus 3.7, and that's going to be 7.53 years, and then it'll be 277 plus 350. Oh, that's not bad. So 7.53 years, and then 627K debt paid off. Okay. All right. So now, okay, so now we're good. And yep, so maxed out credit cards, no problem, right? It shouldn't drain you. Unless you literally have like, even if all your debts were paid off and you have more in expenses than income, then that's when it becomes a problem, right? I would say like when does velocity banking not work is when this number is bigger than this number, right? But when you have debt and this number is bigger than this number, especially a ton of debt, then you should be fine. You should be fine. All right, well, that's it for today, folks. This is Korean Lanta Mentorship. I know you've missed me, so you can type in the comments, I missed you, dear leader. No, I'm just kidding. I'm not, am I learning from the tactics of a certain country up in the north? The dear leader, right? No, you don't have to write that in the comments. But if you do, you can. You could say, I miss you, dear leader, but you don't have to. I'm not a I'm not a leader from the north, so I'll just say that. Okay, well that's it for today, folks. This is Korean Lanta Mentorship. Have a great day, and I'll see you all in the next video.